Hello out there, dividend growth stock investors. Happy Friday to you. It's Colby, the DGI Crab, coming at you once again with the weekly Friday video at the end of the trading day, or the end of the trading week, I guess I should say. We're going to take a look at all 60 stocks that this channel focuses on, try to examine where the value lies, make a plan over the weekend for what we're going to be taking a look at going into next week for investing. It's always good to have a plan going into Monday so you get a good feel for where the market is. It's always a couple of days over the weekend where you can kind of sit back, analyze where things wound up, and decide where you want to go with that new capital for the coming week. Got a new stock that I added to the DJI Crab portfolio I'm doing here on the channel. So I'm going to go over that one a little bit here with you today. And I am absolutely all in on Pepsi, one of my top 10 favorite dividend growth stocks out there. It is absolutely a screaming buy in the opinion of this one crab. If you are new to the channel, I do only focus on 60 individual growth stocks split into tiers based on the age and time horizon of the investor. I'm not a professional financial advisor, and the content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. So the DJI Crab Allocation Strategy, if you are not new here, you can feel free to skip past this part, but I'm going to go over it every time for anyone that's new out there. I put a minimum of 50% of new money into age-appropriate ETFs. I'll get into that a little bit later as to what I think that those ETF allocations ought to look like. And I'm looking, when it comes to single stocks, for stocks that are yielding 30% or more above their 4-year average yield. I update that 4-year average yield every single Friday, so we have the most up-to-date information possible. My top 10 favorite stocks, Pepsi being one of those, is just my own personal preference. If any of those 10 stocks happen to yield 20% or more above their 4-year average yield, they are in my buy zone. I don't even wait for them to get to that 30% mark. I remain within my personal tier unless there happens to be a stock at a different tier yielding 50% or more above the 4-year average yield. At that point, it's just too much on sale for me to ignore. And then finally, if there's not a buyable stock within my tier, I don't sit back and park more cash. I just put more money into ETFs for that particular investing week. So that way I definitely stay not only at 50%, but above. So let's hop into the spreadsheet here, you guys. This is the Tier 1 tab. These are stocks for the 18 to 30-year-old investor where we're looking for lower starting yield, usually in that 1 to 1.5% range, but with a very high dividend growth rate. 12% or better cumulatively is what we're really hoping to achieve here with this group of stocks. Nike and Nordson remain in that buy zone for me. We're looking at the valuation tab here. Anything that's 30% or more undervalued shows up here in the green. 20 to 29% in the yellow. Yellow ones still aren't a terrible purchase. I wouldn't turn my nose up at you if you were buying stocks in this particular range. And anything in the red, I'm just holding and allowing dividend reinvestment to continue to gradually grow my position. I'm not actively adding new money to it because they're just stocks that aren't on sale enough for me. Nike's 1-year or 4-year average yield is 1.15%. You can get that more than a full basis point higher, a full percent higher, 100 basis points higher, 2.18% yield. I'm going to continue buying Nike so long as it stays down here in the 70s, week in and week out. Apparently, Bill Ackman is doing the same as well. You might take a Google search of that one and see what Bill Ackman has to think about that one. Not an investor known for holding a lot of different positions, but apparently he's been sniffing around Nike. Nordson, I'm really happy to add Nordson right now, yielding 1.5%. The 4-year average yield isn't even 1%. So you are getting a awesome deal here on Nordson, a stock that is typically going to do dividend increases in the teens, which is exactly what we want in this category to really get that dividend snowball rolling. Nothing else here really jumps out at me right now. I was hoping UNH would continue to its slide and get down below $500 so I could start adding some money into that. It's not a bad purchase here at $513, but for me personally, I'm gonna wait a little bit on that one. Tier 2, for the age 31 to 41-year-old investors. I'm in this category for another 9 months or so. This is where you're getting starting yield, usually in the 2 to 3% range. We're looking for high single-digit dividend growth, 7 to 9%. Hershey, Target, and have been in this buy zone for me for several weeks now, or even a few months. In the case of Hershey, American States Water has moved into the buy zone, and I initiated a very small position in that in the DJI Crab channel portfolio, which I'll go over later in the video. American States Water has been flirting with buy zone, but hasn't quite gotten there yet, and then today it dropped down just enough that it allowed me to initiate that position. It is a super dividend king, really. It's nearing in on 70 consecutive years of dividend increases. It is the smallest company by market cap among the 60 stocks that this channel focuses on, but its remarkable consistency and super long track record of increasing dividends year over year is what got it this spot in the channel. It is a 1.84% average yielding stock, currently yielding 2.44%. That's plenty good enough for me. It definitely has a very, very steady history of doing dividend increases in the high single digits. I am quite happy to add American States Water. Not anything exciting, but just super steady is exactly what I want in my portfolio for the long term. McCormick almost got there as well. There's multiple stocks that are in my personal buy zone. Back there in tier 1, the two in the buy zone, Nike and Nordson, are both 50% or more above the 4-year average yield. So those are stocks that are great for an investor of just about any age, unless you're, maybe well into your 50s and really trying to increase your dividend yield quickly with your new money. So those were definitely two that I'm looking at adding. And then I added more Hershey, Target, and American States Water. Didn't quite have room for McCormick, but if McCormick gets just even a 10 or 20 cents lower per share than that, I'm going to be looking at adding that into the portfolio as well next week. So very, very close there for McCormick. Tier 3, age 42 to 53-year-old investors. Starting yield's usually going to look more like 3 to 4% in this category. Still want good, solid dividend growth, but it might be more like 5 to 7% as opposed to 7 to 9 like in Tier 2. Archer Daniels Midland, hovering here at $50, absolutely is a fantastic deal for me. I'm going to keep buying Archer Daniels Midland until they get out of their own way and get their share price back where it probably needs to be. 4-year average yield, 2.44%. Right now, sitting at a 4% yield. I will take it. Hormel continues to be an undervalued stock, just can't get out of this low $30 range. I think it's still a nice solid add here, yielding 3.7%. American Tower gives us excellent value in the REIT space. For me, I'm more of a person that adds REITs to a Roth IRA for the tax advantages. But if you're okay with having some REITs in your brokerage as well, American States Water yielding comfortably above 3.5% is a really nice add. Genuine Parts Company remains very affordable as well. I definitely like this one, yielding 3.42%. And then Pepsi, one of my top 10 favorite stocks. If this number hits 20%, I go ahead and buy. Pepsi is actually officially in my buy zone of any stock at 30% or more undervalued. I am all over this one. Love adding Pepsi here. Under $150 a share, you better believe it. And Johnson & Johnson as well, also one of my top 10 favorite stocks. It is 25.5% undervalued, 2.74% 4-year average yield. You can get it yielding at 3.44%. How much is RFK Jr. really going to affect a gigantic company like Johnson & Johnson? I don't know. I think that there's just a lot of fear and uncertainty around this one. Johnson & Johnson, one of the steadiest stocks out there for dividend growth investors. I'm going to take advantage of this one anytime that it is on sale. Tier 4, 54 and older investors, we're looking to add higher starting yield immediately here. We want to get at least 5% cumulative starting yield, if not higher. 2 to 4% annual dividend growth, so that way even when you're not reinvesting dividends anymore, you can still expect to get halfway decent raises to at least keep pace with inflation. Realty income, mentioned over the last couple of weeks, if that current yield hits 6%, That's usually at a point where I feel pretty good about jumping in and buying it. Realty income went up a little bit this week. It was at that 6% mark last week, and it's recovered just a little bit, but I definitely would keep my eyes very close on this one. If you're the type of investor that likes to place limit orders, a lot of people might want to set a limit order, and look for it to where it hits, above that 6% starting yield, and then you can grab a share or two shares, or however much you can happen to afford at any given time. Nothing else here in the buy zone. I am still waiting for some of these higher yielders to correct a little bit, but I don't see anything that's a fantastic value here. NNN REIT, not a bad deal at current prices, but I would rather buy Realty Income right now over NNN REIT if I had to choose one or the other. My top 10 favorite stocks, I keep them on their own little separate tab here. Not a new group. These can all be found somewhere between tiers 1 through 3. But I do keep them on a separate tab just so I can really keep a close eye on them. Pepsi and J&J, absolutely in my buy zone. McDonald's, Union Pacific, and Coca-Cola are all yielding a little bit higher than their 4-year average yield, but not significantly enough that I would emphasize putting new money into them over Pepsi or J&J right now. Great time to be building a position in those two stocks. I can't emphasize that enough. So let's talk about the DJI Crab Strategy here. I mentioned at the top, 50% new money goes into age-appropriate ETFs. For the younger investors, I think the S&P 500 is a great place to emphasize a good chunk of your money, like 25%. 15% small cap value, 5% dividend growth, 5% international. You'll notice VYMI is my international investment all the way across the board, regardless of tiers. Tier 2, same for ETFs, different emphasis where dividend growth gets the bulk of it, and then a little bit less in the S&P 500 and small cap, but still adding to those. Tier 3, I shifted this up a little bit. SCHD has just done so much better than VYM, I should say, and DHS over this last year, that if I were in Tier 3 right now, I'd add money to all three, but I'm going to put most of it into SCHD and then trickle the rest into VYM and DHS. Still like VYM and DHS, but at this point, SCHD has just done so much better. Can't argue with results. And then Tier 4, I'm going to do 15% into high-yielding stocks. SPYD is really, solid, boring, but stable ETF to do that. And then I like to put a lot of money into alternative investments like high-yield bonds, preferred shares, MLPs, covered call ETFs, and international once again. And then the single stock allocations, man, again, another week where there's a lot of different values out there in this group of 60 stocks. You could spread the love around quite a bit. You could emphasize one particular position if you like, but I like to allocate the money around, spread it out a bit, and make sure that I'm adding to anything that looks undervalued while it's there, because you never know how long a stock will remain undervalued. Sometimes, like with Nike or Archer Daniels Midland, they stay down for a while. Other times, like we've seen earlier this year with McCormick, for example, or NextEra Energy, they'll be cheap for a week or two and then they'll recover. For Tier 1, Nike and Nordson, 15% each, the two undervalued stocks in that tier. And then I'd be adding a little bit into Pepsi and J&J. Hershey, 50% or more undervalued from Tier 2. ADM, 50% or more undervalued from Tier 3. That's the allocation for Tier 1. For Tier 2, exactly what I did. 10% Hershey, 5 each into Target and AWR. That takes care of my Tier 2 stuff. Pepsi, J&J, Nike, Nordson, ATM. And then for Tier 3, Pepsi gets the lion's share, if you can call it that, and then just a bunch of 5%ers into J&J, ADM, Hormel, GPC, AMT, Nike, Hershey, Nordson. This kind of runs the gamut of all of those undervalued stocks practically. And then for Tier 4, nothing in the Tier 4 is undervalued at this point, so I would double down on all the ETFs across the board except for VYMI, and then I'd throw that extra 5% into Pepsi. Why not? And just real quick, I'll show you what I added here. You can take a look at how this DJI Crab portfolio has progressed. Still fairly new here, but I did exactly what I said on the previous tab. I hit those 4 ETFs. 10 went into Pepsi, 10 went into Hershey, and then 5s down the board for Target, Nike, ADM, J&J, Nordson,